Welcome back, market enthusiasts. Today's explainer is taking a really deep dive into the third and final volume of Dr. Al Brooks's absolute masterwork on technical analysis. If you've ever been totally crushed trying to pick a market bottom, perfectly timing what you swore was the bounce, only to watch your portfolio just bleed out, well, you are in exactly the right place. We're going to uncover how to actually survive and profit from major market turns without, stepping in front of a speeding train.
Seriously, we've all felt the sting of buying what we confidently thought was the absolute bottom, right? Only to watch the market plummet even further and completely crush our position. We've all paid that market tuition, maybe even donated a little too generously to the market gods. Trying to catch a falling knife is kind of this painful rite of passage for traders, but that's exactly why we need to rethink market reversals entirely. Look, reversals are rarely random accidents. They're actually the climax of this highly structured, brutal struggle between massive institutional buyers and sellers.
Okay, let's just quickly lay out the agenda for this explainer. We're covering 5 crucial pillars today. First, the anatomy of a reversal. Second, the 4-step sequence. Third, traps, climaxes, and wedges. Fourth, precise execution tactics for your signal and entry. And finally, number 5, the cold hard math of the trader equation.
All right, let's jump right into section 1, anatomy of a reversal, the freight train. So there's this stark contrast between how amateurs and professionals view the exact same plunging chart. To master market reversals, we absolutely have to shatter this retail myth that you should try to predict and pick every top and bottom in real time just because you're terrified of missing out. Think of a strong trend as having enormous momentum, literally like a heavy freight train traveling at full speed. Panicked retail traders, they try to stand right on the tracks and push against it with their tiny accounts. But smart institutions, they wait. They patiently wait for that train to hit a massive wall of liquidity, break its tracks, and completely fail to move forward before they'd even consider stepping in. And that institutional patience, it isn't just a virtue, it's absolutely mandatory for survival. Because of market inertia, which is just the market's absolute tendency to keep doing whatever it's currently doing, 80% of all reversal attempts in a strong trend are going to fail. 80%! Why? Well, because massive institutions are still actively trapped, or they're methodically scaling into their positions. The underlying pressure hasn't actually shifted yet. So when you see a plunging bear trend, 80% of the time, that single, tempting little green candle you really want to buy is nothing more than a brief, agonizing pause before the aggressive selling violently resumes. Moving right along to section 2, the 4-step sequence, the core engine. This sequence is the absolute crown jewel of Brooks' reversal methodology, the major trend reversal setup. It transforms chaotic top picking into a logical, high-probability blueprint. It essentially plays out like a literal battle narrative between the bulls and the bears. Step 1, you've got a strong established trend. Step 2 is a powerful counter-trend breakout that aggressively breaks the major trend line. This is the bears landing a massive punch, right? Proving they have real structural power. Then, step 3 is where the magic happens. You wait for a weak retest. The bulls try to rally and resume the original trend, but they completely lack momentum. This weak retest is the ultimate trap for the original trend followers. They buy in thinking the trend is resuming, but nope, it's a dead cat bounce. Finally, step 4, the retest failure, marked by a strong signal bar. You let the bears prove their strength first, wait for the bulls to entirely exhaust themselves, and only then do you strike. That brings us to section 3, traps, climaxes, and wedges. Translating patterns. The crucial takeaway here is that this exact 4-step mechanic we just talked about, it actually powers the famous chart patterns you're already familiar with. Textbook patterns aren't just, magic shapes you blindly memorize from some trading forum. They are brutal, deliberate institutional traps. Take a climax reversal. It's really just a vacuum that sucks in panicked retail buyers at the absolute worst moment. A double top, that's just a failed retest trapping late breakout buyers underwater. And a head and shoulders. Fundamentally, it's just a specific variation of that major trend reversal sequence we just discussed. Let's look a bit closer at the psychology of how these traps are actually sprung. A higher high double top briefly punches above an old high, which immediately triggers a flood of buy stops, tricking breakout buyers into the market before instantly reversing and trapping them. It's brutal. Then you have wedges. Wedges operate on this grueling psychological cycle of 3 clear pushes. With each attempt, the momentum noticeably decays, basically exhausting traders who keep buying the dip until they finally just give up. And climax walls? Those happen when massive trend bars accelerate vertically, creating what is essentially an air pocket vacuum. If you've ever watched the tape during this, it feels so chaotic and parabolic. But once smart money suddenly takes profits into all that frantic retail buying, the price collapses straight down because, well, there's simply no buyers left to support the market.
So to accurately spot these trend fractures, Brooks really emphasizes looking for the moving average gap bar. This happens when an entire price bar, we're talking the high, the low, the open, and the close, stays completely separated from the 20-period exponential moving average. The first gap bar in a long trend is a massive structural event. It's the objective proof traders have been waiting for, and it completely removes the guesswork from the equation. It is visual confirmation that countertrend institutions have finally gained enough raw power to push the price entirely across the moving average, officially fracturing the structural integrity of the trend.
Now for Section 4, Execution, Signal and Entry, Pinpointing the Turn.
Okay, recognizing a structural trap is great for high-level analysis, but to actually trade safely and protect your capital, you have to know the exact bar and tick to place your order. The signal bar alerts you that a pattern is finally complete. Picture a solid red body with a prominent upper wick showing aggressive rejection. But, and this is absolutely huge, you do not enter on the signal bar itself. Instead, you place a stop order exactly one tick beyond its extreme. The entry bar is the actual subsequent bar that triggers your trade by breaking that extreme. Think of this as your ultimate safety mechanism. If the market just keeps stubbornly rallying and never breaks the signal bar's low, your trade never even triggers. You get to experience the immense relief of being saved from a losing position, simply because you waited for the market to confirm your premise.
Finally, we reach Section 5, the trader equation, the mathematics of reversals.
Let's dive into the strict risk management rules that actually keep you alive in this game. Because reversal trading is inherently volatile, your protective stop loss cannot just be placed at some arbitrary random dollar amount just because it feels comfortable to your account size. No way. It has to be placed at a structural level that proves your trade premise was objectively wrong. This stop loss is usually placed exactly one tick above the absolute highest point of the signal bar or the overall reversal structure. If the price goes there, your entire thesis for the reversal has failed, and you must exit the trade immediately without a single second thought. And here is the harsh mathematical reality of catching market turns. When you enter a reversal early, your statistical win rate is often only around 40%. I know, it feels terrible, but it is entirely by design. Remember market inertia? That speeding freight train is constantly fighting you, trying its absolute hardest to resume the original trend. This means you are mathematically going to experience a 60% loss rate on these specific setups. Yep, you are literally going to be wrong more often than you're right. So you might be wondering, how on earth do professional traders remain highly profitable despite losing 60% of the time? Well, the trader equation strictly dictates that your potential reward, which is often calculated using measured moves based on the exact size of the pattern, must be at least 2 to 3 times larger than your initial risk. If you risk $100 on a trade, your structural target has to be at least $300. This is the absolute aha moment of reversal math. A strict 3-to-1 risk-to-reward ratio easily absorbs all those frequent, tiny losses and guarantees long-term profitability when that massive overarching reversal finally hits and just runs for hours. Pulling this off requires immense, almost superhuman psychological discipline. Just think about what you're actually doing. You are forcing yourself to step into the market at points of maximum fear and maximum greed. When the chart is plunging and the news headlines are screaming absolute panic, you have to calmly step in and buy the climax exhaustion. And when euphoria is at its absolute peak, you have to calmly short the trap. Al Brooks' ultimate mandate for traders is this: to survive as a reversal trader, you must transform yourself into an objective, unemotional chart reader. You have to view the market not as some terrifying roller coaster, but as a cold, probabilistic map of institutional order flow. So here's a question to leave you with. The next time you see a massive parabolic surge on your screen, you have a choice to make. Will you surrender to the fear of missing out and blindly gamble your capital on a top? Or will you sit on your hands, wait patiently for the train to hit the wall, the trend line to shatter, and the institutional trap to spring? The chart is going to give you the answer, bar by bar, if you have the discipline to wait for it.